We're joined by Francis Newton Stacy, Director of Strategy at Optimal Capital. So, Francis, I do want to start with some of those bond yields. A pretty interesting move here, because it doesn't seem too long ago that we were talking about an economy that was overheating. Inflation risks were one of the biggest things that investors had been talking about. And now it seems as if we've done an almost about face. What do you make of these recent moves that we are seeing with some of these bond yields?
I think the most important thing to remember is that markets are anticipatory. So we actually started the inflationary and reopening trade upon the vaccine announcement on November 9th, right? And there was nothing in the economic data that indicated that that trade was valid. But markets try to price the next thing in, the next thing in, the next thing in. And markets have, went ahead and priced in, when you had a relative weakness in the NASDAQ, they priced in rising interest rates. And they priced in the possibility of inflation being rampant rather than transitory. But now markets are trying to price in the next thing. And we do have some deflationary pressures coming into the system toward the end of the year, and deflationary pressures mitigate inflation. I always think of these things as a seesaw. And so because we have those things, the thing that got us to all-time highs is we had record acceleration in growth, record acceleration in inflation. We had acceleration in corporate profits, and then we had record monetary and fiscal stimulus. And those five things got us to these all-time highs. So when we look at maintaining these all-time highs and these valuations, if you have a softening on any one of these 5 points, the market is going to reprice that. And I think we've lost some enthusiasm with regards to earnings. When we look at valuations, if you remove the inflationary component on the 10-year, obviously you're going to get more support for valuations in quote unquote the tech stocks. But we have to see if earnings also hold true. We have to see if indeed our corporate taxes are going to go up. And we have to see if some of the supply chain disruption in input costs affects those balance sheets as well. So this is a delicate balance. But I think the important thing to note is that we have a possibility here that inflation has peaked ahead of growth against those Q3 year-over-year readings.
So, Francis, does that mean that the market is going to climb higher without that huge inflation hurdle? It's going to need to, or at least investors thought it would need to clear. If inflation looks like it is indeed going to be transitory, what is out there right now that could stop the market from moving higher?
Well, exactly to your point, we don't know until we have more data. All we can price in is the fact that we have the possibility that inflation has peaked ahead of growth. Now, in the second quarter, we had the worst numbers in history. So any numbers compared to that for the second quarter this year, we're going to show an obvious acceleration. You have exactly the opposite in the third quarter. You have record acceleration off of the lows last year. And now, even if the numbers are super, super strong, they're going to show a dramatic deceleration in those, 5 points. So until the market has new data, for instance, Janet Yellen testified earlier this year that 1 in 10 were not paying their mortgages. I know that people are now starting to come out of forbearance, but we don't know what the ultimate result is of those 10% as far as, what of those loans is going to default. You also have that she testified that 1 in 5 were not paying their rents. The eviction moratorium has been extended, so you don't know ultimately the impact of that. These are potential deflationary pressures coming into the system. Another one of those 5 factors is the fiscal spending. The fiscal spending, even though these packages remain trillions and trillions of dollars, the rate at which this money is being put into circulation has slowed, because now the packages have trillions coming in over a number of years rather than these direct liquidity injections. The Fed so far is holding pat with $120 billion in bond purchases a month, right? And they've talked about potentially tapering. Some speculation between experts is, are they going to back off of the mortgage-backed securities first, as they have 40 billion of those and they have 80 billion of treasuries. And they're going to have to respond to that based on the rate that fiscal spending decelerates, because as fiscal spending decelerates, that is de facto tightening a little bit, because even though, we're still spending more and more and more, we're spending at a different rate, and market participants are going to price that in. So having these potential deflationary things coming into the system at the end of the year is starting to potentially confirm the narrative that inflation could indeed be transitory. And it's also starting to confirm the narrative that the Fed is going to remain easy. So that gives the stock market the comfort of the Fed ease, with interest rates not going up, and until we have further data about earnings or other potential problems with valuations, you're exactly right. We'll probably have another leg higher.
Frances, I'd love to get your thoughts on an area that has been red hot lately, and that is the small cap stocks. We've seen the Russell 2000 index up about 50% since September. Do you think that there is more room to run, or has the Russell peaked for now?
Well, that's the key point, is for now, right? So, for instance, they are relatively, quote unquote, cheaper in the scheme of things, right? But if you consider that the NASDAQ is since COVID, is more of a defensive play, and you consider that we could have a stop off in deflation before we have a reacceleration when we wash out the base effects, that, the anomalies and the base effects and other things that occurred because of COVID. So if you have the stop off in the deflationary perspective, you're going to see defensive things. The US dollar is up today ahead of the Fed minutes. Gold is maintaining a high level. Duration is obviously getting a bid with the lowering of the interest rates. You're going to see some of the defensive things that worked during COVID, the stay at home or the tech stocks. In the interim, before you see that people go back to this idea that, okay, we are indeed reopening. We didn't have another full lockdown on the Delta variant, if it turns out to be that's the case. And now we look at the relative cheapness of the cyclical. So I feel like that stop off in deflation and some of the economic changes that are occurring while the supply chain disruptions change. I think the canary in the coal mine was the sell off in lumber, to say, whoa, we're backing off of some of these commodity prices, which of course trades inverse to the dollar. So I do think, it depends on your time horizon. I do think ultimately the cyclicals will get another bid just because they are cheaper. But I think for right now, the reopening has been fully priced in. And I do think that markets are anticipating potential headwinds coming into the latter half of the year.
All right, Frances Newton Stacy, Director of Strategy at Optimal Capital. Thanks so much for joining us, as always.